All right, welcome again. Now we're going to focus on, so this is FAC2602. And this is 2024 paper, semester 1, assessment 4. Right, so if you can get that paper, if you would like a hard copy, all right, and you go through that, then that can help. Otherwise, you can just try to follow the principles as we explain them in here. So I've left this page on the proposed timetable so that we can talk a bit about something. So the instruction here says, avoid deviating from this as far as possible. Now, what this means is, in every question that you come across, there's going to be easy marks, right? You will see that this is 20 marks and 36 minutes. It's very easy to get the first 10 marks. And that first 10 marks might take us even 8 minutes, very easy. But the other 5 marks might take us 10 minutes, right? And the final 5 minutes, right, might take us, let's say, 20 minutes to get. All right. So you see here that the first 10 minutes the first 10 marks could be so easy, just 8 minutes, because those are the things that you remember quickly. You don't have to do calculations, you already know. Then the next 5 minutes might take more, and the next 5 marks might take more minutes, and the other 5. So you see that you can spend 20 minutes to try and get 5 marks and still not be able to get those 5 marks. Because now that takes a lot of time. But if you have taken these 20 minutes, all right, so let's say you just do like 20 minutes, all right, on this one, and you have 15 out of 20 already. Or let's say you have 15 out of 20. This is just for the purpose of a discussion. And these 20 minutes here that you are going to use, you come and do this question. Now, within 20 minutes, you probably have gotten 10 marks from the next question. Whereas if you had spent that 20 minutes, right, doing this question 1, you are trying to get these 5 marks, you could spend 20 minutes and lose 5 marks, not get them, because that's the hardest part, maybe, right? But if you had gone to question 2, those 20 minutes, you would have gotten 10 marks. You see, there's always a benefit in even if you haven't finished a question, there's always a benefit in moving to the next. Because the reason why you cannot finish a question in time is now you have come to the most difficult parts, which take a lot of time. And after taking a lot of time from you, they give you back very little. In other words, you don't get as many marks. So it's better to use those minutes in the next question and get as many marks before the term runs out. So this is an important examination technique that you need to make sure you apply. So your standard paper in the examination also, basically in the examination. So this was the equivalent, assessment 4 was the equivalent of an exam paper, right? So this is assessment 4 for 2024. This was the equivalent of an exam paper. So in your examination, you first of all expect question 1, all right, to be question 1, you should expect question 1 to cover journals. So those journals that you see in your learning units, they will ask you about them. So today we're going to start with question 1, and we're going to be doing the journal entries. Right, so they're required for question 1. This is for the year ended 31 July 2023. And then the required says prepare the following pro forma journal entries of the Carey Limited Group for this particular year. So what do we need to do? We need to eliminate the owner's equity at acquisition. Now, this has to do with the investment in ordinary shares. This is a very, very basic, right? Very basic journal entry that we wouldn't expect a student at any level to struggle with this, because it's the very basic introduction. Elimination of the owner's equity is a very basic journal entry. So it's a journal entry you should do without any difficulty. All right. And question B says a recording of the non-controlling interest share in the current year revaluation surplus of Fresh Limited. And question C says elimination of the unrealized profit and depreciation associated with the sale of the containers. Then question D requires you to eliminate the dividend declared to the non-controlling interests. Now, if I can just give you an insight into these things, you should always expect this in your examination. You must always expect this elimination of the dividends from the dividends declared by the subsidiary. This is a question you must always expect. Right? Always expect this question C, where there's a sale of a depreciable asset, and you are required to eliminate the unrealized profits and the depreciation. You must always expect also a question on the elimination of unrealized profit in opening and closing inventory. So that's, you can't go to the examination without knowing those, because there's almost always you will get examined on them. And of course, the rest of these things are very basic. So let's go to the elimination of the owner's equity at acquisition. So this is always an at acquisition journal entry. So we just look at the amounts we had at acquisition. So that's what we want. Right. So the information we have is that we have Kerry Limited, which acquired another entity. And this was on August 1, 2021. So if you look at the dates now, this is 31 July 2023. This year started in 1 August 2022. So this acquisition occurred at the beginning of the previous year. So whenever you come across a question, you must make sure that your dates, your timeline is correct, because sometimes there is an acquisition that occurs during the year. And that means that some profit for the current year before acquisition should be calculated and added to retained earnings. So that's why we need to pay attention to that at all times. Right. So at acquisition, we basically interested in eliminating the share capital. This is what we do. We eliminate the share, no, not the share capital, my apologies, the equity, rather, of the subsidiary on the date of acquisition. So we want to eliminate the equity of the subsidiary. 2, we want to eliminate the investment of the parent. So the parent makes an investment in the subsidiary, and we want to eliminate the investment. So these are the 2 major things we're trying to achieve in when we deal with the acquisition pro forma journal entries. We want to eliminate the equity of the subsidiary on the date of acquisition. And remember, equity is credit entries, unless if one of the equity has, for example, you could have retained earnings being a debit, right? But generally your equity would have credit entries. So to eliminate that, you need to credit all the capital, right? So that should be very easy. You need to credit all you need to debit rather, because they have a credit entry. So you need to debit the equity of the subsidiary. So we look here. So I see retained earnings with 243 on the date of acquisition, revaluation surplus with this on the date of acquisition. So I'm going to debit my share capital, because I'm told here the issued share capital of both companies remained unchanged since incorporation. So in any question you go through, the issued share capital remains unchanged, whether that is mentioned or not. Right? Remember that the share capital will always remain unchanged. So I'm going to debit my retained earnings. I'm going to debit my revaluation surplus. I'm going to debit my share capital. And my investment, I'm going to credit my investment in the subsidiary, right? And always remember that when it comes to revaluation surplus, this balance at acquisition is the carrying amount in the books of the subsidiary. This is what is recorded in the books. So sometimes there is an adjustment, a revaluation adjustment, which needs to be added to the revaluation surplus. When you go to third level, you will also have adjustments that will affect retained earnings. But for second level, we have valuation adjustments that only affect the revaluation surplus. So if you look here, we are told that on acquisition date, the property of Fresh Limited had an estimated resale property of 5.6, which would increase the revaluation surplus at that date by 75,000. So we need to say plus 75,000. Right? The amount was not recorded. The property was revalued again on this date as per the policy. Right? We will come back to that. But now we just have, we want the state on the date of acquisition. So we're going to debit revaluation surplus, the amount given, plus the revaluation gain on acquisition. So sometimes it might be a loss, right? We need to subtract it. A gain, we need to add it. Right? So that's with debit retained earnings, debit revaluation surplus, debit share capital of the subsidiary, right? So the share capital of the subsidiary is 1,320. We need to debit that. And then we go to the investment in subsidiary. This amount, we need to credit this amount. So we have amounts that we have that have become debt credits. So this is going to be a credit entry. This is going to be a debit entry for the subsidiary. This is a debit entry. This is a debit entry. Now, remember that we are acquiring this company, right? So we need to know the percentage of the NCI so that we can also allocate the NCI, their share of the subsidiary on the date of acquisition. So we need to determine what's the percentage shareholding. And like we always say, the percentage shareholding is based on the number of shares acquired. So the number of shares acquired is 210,000. And then the number of shares issued by the subsidiary is 300 shares. Right? This is issued by the subsidiary. So we acquired 210, or rather the parent acquired 210,000 shares out of 300,000 shares. So 21 out of 30, that's more like 70%. So 30% of this company, of the equity, belongs to the NCI. So what we're going to do, we're going to calculate the entire equity, which is share capital plus retained earnings plus revaluation surplus. Then 30% belongs to the NCI, and the NCI is a credit. And then from there, we're going to determine what the goodwill is as a balancing figure. So the goodwill is going to be a balancing figure. So here's the solution. We credit share capital of the subsidiary. Simple and straightforward. All right. Retained earnings of the subsidiary, simple and straightforward. Revaluation surplus, we add the gain, simple and straightforward. Investment in fresh is a credit, simple and straightforward. NCI, the share of the non-controlling interests. So we take all the equity of we take the equity of the subsidiary. So that's your share capital plus your retained earnings plus your revaluation surplus, then times 30%. All right, so 30% of that is going to be equal to this amount. So that's our NCI. Now we're going to balance the credit side with the debit side. All right. So if you add up your debit side there, it's going to give you 1, 8, all right? What type of mathematics is this? 1, 8, 8, 3. Am I right here? Right, let me use my calculator so that I can be more accurate. So I have 1320123 plus 243 plus 320. So I get 11883. Then on my credit side, I get 1318100 plus 564,900. So I also get 1883. So which means that there is no goodwill, right? Because the debit side is equal to the credit side. If the credit side was bigger, right, then the balancing figure on the debit side would be the goodwill, right? So that would be the journal entries that we have to do to eliminate acquisition, right? So I don't think that is difficult. That should be very easy to follow. Then the next journal entry it has to do with the non-controlling interest share of the current year revaluation surplus. Right? So for us to be able to understand the current year revaluation surplus, we need to be able to follow the revaluation history, what was happening in the revaluation. Right? It's very important because sometimes a revaluation is not recorded when it happens on the date of acquisition, right? But then eventually they will do a revaluation. So we need to remember that so that we don't duplicate a revaluation surplus. So that's very important. We need to make sure that we do not duplicate a revaluation surplus. So if you listen here, the carrying amount, if we go into the records of the book of the subsidiary on this date, they have 245. Then we assess the assets and liabilities, and then we see that in determining the fair value of the assets and liabilities, the fair value of property has a gain of 75,000, which is a revaluation surplus. So we have to add that. Right. But you see that this was not, the amount was not recorded. So when there is now a revaluation, just see the dates. It's 31 July 2023. All right. So when we revalue again, remember that now the subsidiary is going to record it. But from a group perspective, the carrying amount of the revaluation surplus is 245 plus 75. However, from the subsidiary perspective, they're revaluing from 245. So let's explain that. So during the current year, the property was revalued again during the current year, right at the end. So which means that the subsidiary, because this was not recorded, the subsidiary revaluation surplus remained at 245. Right. But now we see after the revaluation surplus on 31 July, now for the subsidiary, always make sure it's the subsidiary, is 380. I think I see properly, right? It's 380,000 for the subsidiary. So there's a gain. So the subsidiary recorded a gain of 380,000, 380,000 less 245,000. So there's a gain that was recorded by the subsidiary of 135,000. Right. But from a group perspective, the carrying amount from the group perspective was not 245, it was 245 plus 75. So from the group perspective, the carrying amount was 320. Therefore, the gain, the revaluation surplus from the group perspective is from 320 to 380. So when we deal with this from a group consolidation perspective, the revaluation surplus is going to be equal to 380 minus 320. That's 60,000. So this one has to be shared now. Was this 75,000 was already shared, right? It was included in the values at acquisition, right? So it was already shared. Now they need to share this new one. This is an old one. They need to share this new one, 60,000, right? So they're going to share that on the basis of the percentage shareholding, right? The parent gets 70% of that. The subsidiary gets 30% of that. All right. So, and your journal entries, because this is a credit, because this is a gain, so this is income, and so you need to say, right. I remember the question. A recording of the non-controlling interest share. So we only need to record the NCI share in the revaluation surplus. So the NCI share then will simply be right. We need so it's a revaluation surplus recorded in the subsidiary, which is fresh, right? It's a revaluation surplus of fresh. We must take 30% of 60,000. All right. And that's 3 times 6. And that's 18,000. And we must give this to the NCI, right? So the NCI doesn't belong to any of these of these companies. So 18,000, right? So the NCI value is increased by 18,000 as a result of this. So the major point here, I would say, was tracking the revaluation surplus, right? From when it was first revalued and that was not recorded, and then there's another revaluation again, right? Right. So that was the key thing that you guys said to pay attention to. And then the other question is elimination of the unrealized profit. So this is very easy, but there's always a challenge with that. So I hope you guys will enjoy that, right? I hope you guys. Okay, so let's see what happened in the transaction. Right. So somebody sold something, right? So let's see who sold to who and what happened. So that also is very easy. That is also very easy. Right, so let's have our debit. Let's have our credit. Who sold anything? Right. Fresh Limited, which is the subsidiary. Purchased equipment comprising of 3 steel containers from Kerry Limited, who is the parent. The manufacturing cost of the containers, the original cost was 25,000. On the date of sale, the carrying amount of the 3 containers was 54,900. Right. So this 25,000 is 25,000 rand each, and then the combined carrying amount was 54,900. Then Kerry sold. So this is the buyer, this is the seller. Kerry Limited sold 3 containers for 21,000 rand each. So the combined selling price was 21,000 times 3, 63,000. Then we subtract the carrying amount, which is 54,900. Right, so let's 54,900. So that's 8,100. This is the profit that I get. You could get a different profit, but that's fine. So now, there are 2 things that we need to pay attention to when dealing with the depreciable assets. Firstly, the date. When was that? Is it this current year? Is it last year? Right. 2, we only focus on the profit or loss made, not on the actual cost or the actual carrying amount. We focus on the profit or loss made. So when we do the adjustment, it's specifically on the profit or loss made. Right. And another reminder is if we make a profit on the sale, like in this case, we will have journal entries, right? But if it was, we will have certain journal entries, right? So I want you to understand those journal entries. And then for a loss, it's just those same journal entries, except that a debit now becomes the credit. So if we make a profit, we're going to debit one account and credit the other. Right. Now, assuming that was a loss, it's just the opposite. The account which was debited gets credited. The account which was credited gets debited. So it's just the opposite of the opposite accounts, right? They swap around. A debit becomes a credit becomes a debit in the case of a loss. So we don't have to do a profit case and also a loss case. Just assume it was a profit, and then you know the journal entries for a profit, then you just swap them around. What would have been debited becomes credited. What would have been credited becomes debited. That's a loss now. Just swap them around. Right. So you just need to know one and swap them around. So it's like you know your way to the mall, right? So you should be able to know your way back from the mall, because the same way if you pass a post office first and then the police station on your way to the mall, then back you must pass the police station first before you pass the post office, right? Because you're reversing that. It's just the opposite. You don't have to try and know it from the other side. So just know the profit and know that the loss is the reverse of that profit for the journal entries. So remember the dates. Also remember that it's either the profit or loss that we deal with. So the profit, the amount that we'll be dealing with is 8,100, right? So when is this? When was this profit recorded? Or when was this profit accrued? So this is on 31 May 2022. And what is our year? Our year is 31 July 2023. So our year started on 1 August, right? 2022. So 31 May 2022 was last year. So this sale transaction was recorded last year, right? So our adjustments start from last year. But now the profit that was made is now in retained earnings, right? because this profit was made last year. So it can be in profit or other income, but it was in other income last year. So it won't be in other income this year. So everything that was profit last year is sitting in retained earnings. So our starting point, whenever we deal with depreciable assets, is to remove the full amount of the profit or loss. So that's very easy, the full amount of the profit. So where is the profit sitting? It's sitting in the retained earnings, right, of the seller. And the seller here is carry limited. So we say carry. So we need to remove that, say, that's not yet realized. It's going to be realized through depreciation. So we deny the seller their profit, right? So we start by the seller's retained earnings, 8,001. So if it was during the current year, right, we wouldn't start by affecting the retained earnings. It would be other income. But so that's why I said the date is very important, right? And the buyer has the asset. So what is the asset here? Containers. I don't know containers if that is that is equipment. So the buyer has equipment. So the equipment of the buyer also contains a value that includes profit. So we must remove the profit there in the equipment. So that's 8,001. And this is the equipment of fresh, right? Or right, you can say equipment fresh. That is perfectly fine. Or some could just say PPE, which is also perfectly fine. Right? You don't have to be really specific because you are not doing the actual pro forma consolidation journal entries. You are just doing an exercise. So this is the first one. That's the first journal entry. The first journal entry is to deny profit from the seller and also deny the buyer who has the asset, the additional valuation of the asset based on the profit. So the equipment was recorded as 63, would you say 63,900 or something? 63,800, 63,000. So that 63,000 includes profit of 8,100. So we would have removed that. So when we prepare our when we prepare the statement of financial position, when we deal with property, we would say PPE, all the amounts given. We start by subtracting the profit here that was made. Then we add back the depreciation realized to date since the day. Right. So if this was a loss, they sold and they made a loss of 8,100. So we're going to credit this retained earnings of the seller and debit PPE of the buyer if this was a loss. Right. So it's just the opposite. So this was going to be the amount to credit. This was going to be the amount to debit if it was a loss. So the account you debited for a profit, you have to credit that account for a loss, right? And so forth. Right now, you start last year, it was used. So the depreciation realized last year should be allowed as income, right? But so the profit, the depreciation realized last year, right, is going to be the profit that we now allow to say, this was realized. So because it's last year, it's still in the retained earnings again. So we have to say, right, we give you the, so we're gonna go to PPE. That's the PPE of what? Of the buyer fresh limited. Sometimes they say accumulated depreciation, but remember accumulated depreciation is part of PPE, right? Right. And then it's fresh, then retained earnings, because we are calculating depreciation realized last year of the seller. The seller is carry, right? And the depreciation realized is calculated on the profit or loss, not on the full amount. So you get marks for writing this correctly. It's the profit All right, figure multiplied by 10%, you get marks for using the correct rate, multiplied by 10%. And for how many months last year? It was 31 May, so we only have June and July, up to 31 July 2023. Because right now we are at 31 July, my apologies, 31 July 2022, right? 31 July 2022. So that's just 2 months. So I'm going to say times 2 over 12. You get a lot of marks for knowing that you use the profit. You get marks for using the correct rate. You get marks for this counting, right? So you get a lot of marks for that. And it's something that you must be comfortable doing. 8,100. So then I multiply by 10%. Then multiply by 2 divided by 12. I get 135. Now, this is very important because at third level, you will have to do also adjustments for taxation. You probably have heard something called deferred tax. So it's gonna throw you, it's gonna confuse you if you don't know these journal entries. Because at third level, you do these journal entries and you add deferred tax, the taxation of this, taxation of that, this side, that side. For each transaction you enter, there's tax consequences. So you need to master this so that when we introduce you to the tax consequences at third level, you guys are not going to. All right, so that's 135. Right, 135. Right. Then during the current year, now there's also a depreciation. So we're going to say the seller can recognize a gain in the asset. So PPE of not the seller, sorry. The buyer is the asset. So my apologies, there is the buyer, and this is fresh. Right. And then the seller can recognize the asset. So this will be under, now you don't say other income, so the other expenses, or simply depreciation. So some just say depreciation here. Some say accumulated depreciation here. That's the same thing. It's just a different name. So this was for a full year. So you get marks for making the correct amount, 8,100 times 10% times 12 over 12. So that's going to be 810 that you give there, at 810 that you give there. Right? Brilliant. So then you get your marks. Right? That shouldn't be too difficult for you. Right, so we said if it was a loss, remember, you just do the opposite. So this account here, you still calculate the depreciation the same way. And this account here was going to be credited. So you credit PPE with 810, and this depreciation or other expenses will be debited with 810 if there was a loss. So remember that. Right? So that's your journal entries. Then finally, elimination of dividend declared to NCI. So dividend declared, how many dividends do we have here? You're not going to check. Oh, by the way, we don't have preference shares. Do we have them? So the the subsidiary doesn't have preference shares. All right. So then the dividends declared by the subsidiary are only based on the ordinary shares. So remember the NCI gets 30% of the dividends, and then the parent gets 70%. Right. So they declared 28 cents per share. So that means I'm going to say they're going to get 30% of that 28, and the number of shares issued by the subsidiary, 300,000. So we take the number of shares, 300,000. Right? So they get 30% of that. So that's 30% multiplied by 0.28 multiplied by 300,000. So I get 25,200. That is what they get. So if I can just do a journal entries for everything, right? So this is the journal entry for unrealized profit on sale of equipment. Now this is for just for NCI, but if you want to include everything, then you will have also the what is this thing called? Dividend income, dividend received. If you also want to eliminate for the parent, so that will be 70% of the amount, right? So this is 0.28, sorry. So you would have 70% here. And then dividends payable would be the full amount, including everything, right? That's to say, if you're going to eliminate dividends and also allocate to NCI, that is what you would do. But if they say allocate to NCI only, just do for NCI and the dividends payable. Right, so then the other journal entry that you must expect, I said, you need to know the unrealized profit in inventory. So your standard is, this is the standard journal entry. So if there is unrealized profit in opening and closing inventory. So let's say there's opening inventory and closing inventory, and there's unrealized profit, right? So you start by affecting the retained earnings, right, of the seller, because the seller last year already recorded the profit, but so that profit is sitting in the retained earnings of the seller. So when we open the year, we say, no, your retained earnings are too much because you have recorded some amount as profit, but it's not yet profit. So we start by affecting the retained earnings of the seller. Right, so let me do the right, let me do the complete journal entries. So you start by affecting the retained earnings of the seller to say, let's say we could say the unrealized profit was 20 over 120 multiplied by the value of opening inventory. So whatever we get is here. Then we're going to affect the inventory, opening inventory, right, of the buyer, right? Because the buyer opening inventory would be also too much and say, no, you guys have included unrealized profit in or opening inventory, it should be excluded. So this could be opening inventory or cost of sales, right? Because your opening inventory is going to go into cost of sales, right? Then before I do that, before I talk of cost of sales, let me just say opening inventory of the buyer. Then, right, then that opening inventory gets sold, right? So that opening inventory gets sold, we debit it. That opening inventory gets sold, then we debit that. We're going to credit cost of sales. Right. So do you see here that there's a journal entry to debit, to credit all inventory, and then debit inventory again. So normally what UNISA does, they just ignore the inventory though, because when you do that journal entry, you just credit opening inventory and debit it again. So UNISA generally leaves this out. So you will have retained earnings of the seller affected and cost of sales of the seller also affected. So this is the journal entry you do. For unrealized profit in opening inventory, you debit the retained earnings of the seller with the unrealized profit in opening inventory. Then you credit the cost of sales of the seller again with the same amount. Okay. So that's what you do. That should not be too hard. Then unrealized profit in closing inventory. Remember that the effect here is to increase profit, right? All right. So what I mean is that the unrealized profit will increase profit. We need to reduce that. We need to eliminate that because it's not yet realized. So we're going to increase our cost of sales. That's how we do it. So we're going to debit cost of sales. To debit an expense is to increase it. That is the same thing as increasing an expense is the same thing as reducing profit. So if we increase an expense, cost of sales, by debiting it, 20 over 120 or 25 over 125, multiplied by the closing inventory, right? Then this is the cost of sales of the seller who is being affected because the seller has the profit. Then the one with the asset is the inventory is the buyer. So the examiners want you to write the names of these guys. So the buyer has the inventory and it's also going to be affected like that. So if there was a loss made on the sale, remember, because we don't always sell at a profit, we might sell at a loss because it's our business. We're just trying to do business. So it will be the opposite, the reverse. You just need to know the journal entries for profit. Then for a loss, it's going to be the opposite.